All right. Can everyone hear me? All right, welcome everyone today. Thank you all for joining us. Welcome Dr. Thomas Eisenmann. I see we have attendees from all over the world today. We're going to be talking about why startups fail. So I know people are still joining. Let's get started in the interest of time. So to introduce myself, my name is Fadl Tarzi. I'm the founder and CEO of Nexford University, which is hosting today's session. I founded Nexford along with my partners about 3 years ago with a view that higher education has evaded disruption for quite some time, and the traditional model isn't really fit for purpose anymore, whether for entrepreneurs or for those seeking any other form of upward mobility throughout their careers. So we think of ourselves as a startup and a university at the same time, which is a rather unusual combination. In today's session, we're hosting Dr. Tom Eisenmann, who is a professor at Harvard University, at Harvard Business School, and is also author of Why Startups Fail. I'll hand over to Dr. Tom, perhaps to start with. It would be great if you could give us and give all our attendees today a bit of background on what led you to write the book, and then let's go through some of your key findings, which will set the context for our discussion today.
Fantastic. Thank you, Fadl. Good morning in the Americas, good afternoon in Europe, good evening, and good night, I guess, across Asia. I should mention at the outset, too, that if you are in the UK, I don't know, a lot of you are in the UK or in Commonwealth countries, if they're Commonwealth other than Canada and UK, the book is actually titled The Fail-Safe Startup. Some of the peculiarities of book publishing, the publisher gets to pick the title. It's an identical book. In the US, it's called Why Startups Fail. And the genesis for the book, the inspiration was my realization that I was a failure at explaining failure. Since something, depending on how you define a startup and how you define failure, a majority and maybe a vast majority of startups fail. Probably something like 2/3 of the startups that raise venture capital don't yield a positive return for investors. And this goes back about 8 years. I was teaching the basics of startup management and encouraging a lot of my students to launch startups, and had done that with a pair of founders. They had a fantastic idea, I thought, and I liked both of them. This is after they graduated, went off to consulting for a year, like so many MBAs, and then got tired of that and wanted to launch a business. The concept was better fitting, affordable and stylish apparel for young professional women. And they raised $1 million. They tried to raise $1.5 million, but they raised $1 million, launched the business, tested it, did so many of the things that I taught them well about validating demand for the solution they had in mind. And indeed, there was strong demand and they had good, strong sales, repeat purchases, and yet they still failed. And I could point to many causes, but I wasn't sure, I couldn't pinpoint the root cause. I wasn't sure what really happened. And this was disconcerting. So it caused me to question, was I teaching the right things? And set me on a quest, a multi-year research project to talk to lots and lots of failed founders and the investors who back them, do a lot of research, read everything I could get my hands on about failure. And the result is the book.
Fantastic. So to break it down for people, can you just remind us, so how many founders / startups did you interview over what period of time, which led to publishing the book? The book was just published last month, right?
Yeah, just a couple of weeks ago, as a matter of fact. Research came in waves. Some of the deepest learning came from the learning model at Harvard Business School is case studies. Many of the listeners will be familiar with the case study method at Harvard Business School, and a lot of business schools use this method. So I've written 20 case studies of failed startups, and that approach really forces you to get deep very close to the founder, to the management team, to the investors, and I would say the most powerful learning came from those 20 case studies, and indeed the book. Most of the chapters in the book are anchored by a key case study. The case studies actually turned into a course at Harvard Business School, a course called Entrepreneurial Failure, and I've taught it now twice. And we bring the failed founder into every session, so students actually have an opportunity to explore with the founder. Why did you make this decision? If you'd done it differently, maybe the outcome would have been different. In addition, along the way, I'm sure I've spoken to hundreds of failed founders in interview mode, but not as extensively as a full the research behind a case study, as well as investors. And then the book is informed also by a survey of 470 early stage founders. Fadl, I think you may have, and it's a mix of successful founders and founders whose business is struggling, and some failed founders. And the point of that survey, I think that's how we discovered each other. The point of the survey was to ask them. I asked the founders 40 questions about every aspect of how they ran the business, who they were, what industry were they in, and use that to separate the factors that were driving some towards success and some towards struggling. So lots of research behind the work.
Fantastic. So this isn't academic purely in nature. You've spoken to, you said, about 400 entrepreneurs, a number of VCs and investors, and both successful as well as unsuccessful founders. So having said that, let's start by defining success. So from a startup perspective, so a lot of people are asking questions, whether live today or over the past few weeks since we've announced this webinar. Now, I'd like to start with that because there's a bit of a stigma that success, at least in the US, needs to mean sort of becoming a unicorn or building $1 billion startup. So to our joiners from places like maybe Sub-Saharan Africa or Southeast Asia, or to a lesser extent, maybe India, like the number of unicorns obviously is much smaller than in the US. And some of these markets just aren't large enough to be producing, 10, 20, $100 billion companies a year. So let's just start from your perspective. What would you define as success from a startup perspective? Is it one definition, or is there sort of a range of definitions?
Yeah, you have to ask, if you're asking about success and failure, the first question you have to ask is from whose perspective? And then the second question is against what yardstick, against what measure? And from whose perspective is tricky, because many entrepreneurs will be the owner manager forever. So obviously from whose perspective is from their perspective, but other startups will raise outside capital, and whether it be a bank loan in some cases, but in many other cases it's equity. People will be part owners of the business. And for a fast growing startup, it's usually the case that they're losing money for a while, investing for a while, and have to raise enough capital that with a startup, typically every time you raise a chunk of capital, the investor will join the board of directors. And of course, the job of the board of directors in any company is the most important job is to hire and fire the chief executive officer. At the outset, that will be the founder. But at some point, the founder will have a board that outnumbers the members of management. So the founder is, in a sense, can be fired from the company that he or she built. And that happens in fast-growing startups quite often. So it turns out that after about 5 years, only 40% of high-growth startups are still run by a founder CEO. The founder's been replaced as CEO in these companies 60% of the time. So for a firm like that, the perspective is no longer the personal goals of the founder. Those are obviously relevant, but you do have to ask about other stakeholders, and in particular, the investors who put in so much money. And so the measure I use in the book is, did early investors in the startup make money, will they ever make money? And if they do, that's success. And if they don't, that's failure. But of course, it's important. I mean, founders have personal goals. So they want to change the world. They want to have impact. They want to create jobs. They want to create an organization that will live beyond them. And those are important. And then lastly, we should ask about society. So a venture can be a success from a financial perspective, but do things that we all collectively would prefer didn't happen. They can sell addictive products, whether it be psychologically addictive or physically addictive. They can pollute the environment. They can exacerbate income inequality. So you can be a success, but not from society's perspective. You can be a failure financially and yet show other entrepreneurs what not to do. And that's good for society, right? If an entrepreneur can now solve the problem that you failed to solve because you've shown a path that doesn't work, or the employees in your company, the management team in your company, having learned something, can go off and start new businesses. So this question of success and failure is quite complicated, but the easy definition is investors didn't make money.
Yeah. So investors didn't make money is, a definition from an investor perspective. I guess from a founder perspective, the point I was, leading to is in many instances, startups don't need to be built to exit or for investors to make money, right? Even economies like the US, contrary to what we see in, on Instagram and public media, like the real engine behind economies is often, the small and medium-sized enterprises who are employing 10, 20, 30, 40 people as opposed to, 1,000. And you can have 1,000 of those in a market making money and being profitable, but not, ever becoming a unicorn, but still, they're quite profitable and sustainable businesses. So I just mentioned that because a lot of, entrepreneurs are discouraged when they don't have access to external funding or when they see that, exit opportunities are limited in their markets, whereas that really should not be the case. Building a sustainable, profitable business on the long term is a great alternative to the typical venture-backed model as well, right?
Exactly. Yeah, I would say the students I work with, and I think this is true for a lot of MBAs, we teach about venture capital, and we and I think the students lionize venture capital, but there's so many ways to build a business, and as you say, the vast majority of entrepreneurs bootstrap. They do it with their own resources. Maybe they borrow money from friends and family. That's the path for so many, and we need that. This is important. It's changing the world. It's creating jobs. It's solving important problems. So yes, absolutely.
So let's move over to sort of phases. I know the book is divided in different sections that are all thematically organized. I'll try to match those to some of the questions we have from our attendees today. So let's start with the concept of bad bedfellows. A lot of questions around how to find the right partner. There's different options. So what findings or what insights have you gained from your work that you can share with people with regards to choosing your co-founders and your partners? Is there a correlation between those who choose, say, friends and success, or those who choose founders or partners based on complementary skill sets? Have you found any correlation between how you choose your partners and the type of partner and success you achieve?
Yep. So the pattern in question, the company I mentioned at the beginning, the apparel company, Quincy Apparel, is the anchor case for the chapter in the book that talks about this failure pattern. And the fail pattern is good idea. The entrepreneurs actually have identified a promising opportunity, in this case, better fitting, affordable, stylish apparel for young professional women. But they never managed to bring together the full set of people who need to contribute. And that includes the co-founders, which I'll talk about, but also the rest of the team, the outside investors. And many entrepreneurs will rely on partners because the definition of entrepreneurship is you're doing something new without resources. That's at the core, that's what an entrepreneur is. And other people, other companies often have the resources you need. So you can borrow them. They can help you sell your product. They can help you with technology or inputs for your product. And so in the case of Quincy Apparel, the bad bedfellows were problems with all of those constituencies. But in this case, the co-founders were best friends and actually vowed to never let the disputes over the business get in the way of their friendship. And after the business shut down, one founder forced the other one out of the company through a board dispute. I mean, wasn't person to person, but the board forced one founder out in a dispute over strategy. And the founders weren't on speaking terms for 18 months. Here are these best friends who'd vowed to never let that happen. Actually, the process of me writing a case study of the company brought them back together. They're friends again. But it was painful for a long time. And so there is research, Fadl, that shows that teams comprised of close friends or family members are likely to be less stable. They're more likely to split up the way these Quincy founders split up. And there's some underlying causes there. It is exactly what happened at Quincy, which is the fear that if we fight over the business, that will somehow affect our personal relationship, and bottling that up and not letting the conflict surface actually makes it worse, right? Whatever problem we need to solve in this company has been suppressed because we don't want our personal relationship. And so the best co-founders tend to be people who know each other, know enough about each other to know strengths and weaknesses, who complement each other. I mean, if you're the audience will think of a Venn diagram. If there are three founders, you want the three circles to cover as much area as possible, but you still want enough overlap that the founders can work together.
So, for instance, someone on technology, someone on marketing, someone on, say, finance.
Precisely.
But to your earlier point, so just the takeaway, because throughout the session we sort of want to give people key takeaways. So the takeaway you mentioned is teams that are comprised, or founding teams that are comprised of family members or friends, from your research, have tended to be less successful.
Yeah, I mean, it's easy to find examples of very, very successful husband and wife teams, mother and son teams, but statistically, it boosts your odds of breaking up.
Okay, so that's that I guess is the answer to those asking about how to put together your founding team. So moving on from maybe founding team to idea. So what can you share with us under this theme of whether it's a false positive or a false start, or really thinking about the idea from the very beginning? Many founders will have the inclination to build a business without necessarily having a particular idea, because they're excited by the prospect of being their own bosses and building a business. Others will have a particular idea that they're passionate about. Now that idea may actually be solving a problem or not. And then, of course, there are many others who actually have a specific problem that they view to be worthy of, solving. So, what can you share with us in terms of, the idea from the very beginning of a startup? How do you validate whether that's an idea worth pursuing or not?
Yeah. The first pattern that you talked about is rare. It does happen. I've worked with students who just want to be an entrepreneur, and they have a vague sense for the space in which they want to build a business. And we call this boiling the ocean, right? Sort of a long process. And then basically when all the water goes away, you see what's sort of flopping around on the seabed, and pick this fish or that fish. It doesn't tend, it can work. It doesn't tend to work very well. And far more common is the pattern of an entrepreneur who has a burning vision of an opportunity. And by an opportunity, this is important. We mean both a problem, an unsolved problem, an unmet customer need, and the solution for that problem. And that solution better be distinctive, differentiated from the existing solutions that aren't working so well for these customers. And it needs to be defensible in the sense that you can't be copied quickly by somebody else who come in and do what you're doing. So that's a tough standard, a strong unmet need and a differentiated defensible solution for that need. And what far too many entrepreneurs do, and this is the false start pattern. False start exactly in the sense of athletics, right? A track and field, a sprinter who jumps the gun, a swimmer who jumps off the blocks too quickly. These entrepreneurs have a burning vision of a problem solution pair. They're sure they're right. They're sure they've found a problem and exactly the right solution. And because an entrepreneur's identity is somebody who makes something happen, they have a bias for action. They want to build the thing and sell the thing as fast as they can. And they skip an entire round of what designers would call a design process of exploring customer needs and exploring multiple solutions. And they jump all the way to engineering the product, developing the product without doing enough upfront customer research. And the consequence is they put something out there. It might work. Sometimes it works. But having failed to do this necessary research up front, odds are they will miss the mark. And whether you're bootstrapping or whether you've raised capital from outside, at some point the money is going to run out. And you only have so much time. So if you've got a year's worth of, we call it runway, just like an airplane, so how much on the ground before you can reach the sky? If you've got a 12 months worth of runway, based either on your own resources or the money you've raised, and you use 4 months on a flawed first version of the product, you've really boosted your failure odds. So that's the false start pattern. And then the last pattern is the false positive. And this one is vexing. It's very hard to avoid this failure pattern. So it turns out that every business, every entrepreneurial business, no matter how small, no matter where in the world, needs early adopters, needs those enthusiastic first customers to get the thing going. And it's very, and you must get them and you must satisfy their needs. And it's often the case that the needs of the early adopters are actually different than the needs of the mainstream customers. So sometimes the early adopters are sophisticated power users. They can take your product, which may be built from shoestring and bubble gum, it has a lot of problems, and they're sufficiently sophisticated to self-service, to install it, if they're bugs, they can sort through the bugs, and they can see why what you're doing is so special and will solve their problem. They're foaming at the mouth. They'll refer your product or service to other early adopters. And if you build in that direction and sell in that direction and commit all your resources in that direction, and it turns out that the mainstream customers are different, then you've got a problem. You've got to reorient, because you'll never build a successful business without the mainstream. So the false positive is being seduced, if you will, beguiled by success with the early adopters and not keeping a focus on what you need to recruit the mainstream.
That's a really tricky one. So earlier you said, many people skip the research process and they go into engineering and product development in the interest of going to market. So a lot of time, when you read about sort of more agile product development methods, and even, when you talk to a lot of VCs are anti-research, right? They'll be like, let the market validate your product, right? Build the MVP, go to market, just go as fast as you can. So doesn't that contradict with the concept of, slow down, do a lot of research, and then go to market?
Yeah, no, in fact, a lot of the terms you just mentioned, agile and some of the listeners may be familiar with the concept of a lean startup. It's sort of came out of Silicon Valley about 10 years ago and has really swept the world. I would say many entrepreneurs these days will view themselves as following a lean startup approach. And that approach is essentially applying the scientific method to a new business. You have a hypothesis, like a scientist, and you devise a test. And the test model is put a real product in the hands of real customers quickly. It doesn't have to have all the features. It can be a little rough around the edges, but what you want to do is get feedback from ideally paying customers. And that is fantastic. It's actually an important part of the design process. And many entrepreneurs who fall victim to a false start will think they're following this lean startup approach, and they are. They're putting out a minimum, it's called a minimum viable product. The least set of features and capabilities for the product that you need to get some feedback. and the rhetoric of the lean startup movement actually encourages this: fail fast, just do it. And what these founders miss is actually the lean startup gurus, Steve Blank in particular, talk about a phase that is before the minimum viable product, which is customer discovery. Steve Blank exhorts entrepreneurs to get out of the building and go interview. He'll say 100 potential customers to study their needs. And an impatient entrepreneur can easily talk themselves into skipping that step. I know what the market wants. I know that. And really, I don't think most entrepreneurs need to do 100, but they should probably do 10 or 20 of these conversations. And it doesn't take a long time. This process of research before you start building really can be done in a few weeks, at most a month or two. And boy, to sort of invest 6 weeks up front to avoid losing 4 months from a flawed version of your product, that's a good trade-off.
So it is a good trade-off. And the concept of, fail and fail fast is, well respected and adopted across the world. But again, to push back on the research part, so you have instances ranging from, all the way to Steve Jobs to, much smaller companies who have launched products that, had Steve Jobs gone to the market and asked people, hey guys, would you like an iPod or an iPad, or even an iPhone for that matter, the research would have almost definitely said no, right? Conclusion would have most likely, and in fact it was, right? So I guess the question is, again, how do you balance, or from your research, have you seen or uncovered any insights you could share with our attendees today? How do you balance between asking customers or potential customers for their feedback on a product that they've never experienced, and really following your vision and often creating the demand for a product? Even Uber, you could make the argument 20 years ago, if you had gone to people and said, do you want an app to order a car and you'll be there in a minute? No, why would I want that, right? But often when you haven't experienced the product or the service, you're not sure if you want to buy it. Have you come across this across your research?
Yeah. This is truly important. And in the first place, we've got to be very careful drawing lessons from Steve Jobs. We talk in floods, about a century flood, sort of once in 100 years, the water level rises that high. He's a once in 100-year entrepreneur. So let's set him aside, and we mere mortals can approach entrepreneurship differently. But it's not the customer discovery process we're talking about isn't asking customers what they want. Because you're absolutely right. If they've never experienced the product you envision, there's no way they're going to give feedback. Henry Ford famously said, if I'd asked people if they wanted what they wanted, they would have said a faster horse.
Exactly.
And I never would have learned about the Model T and the cars that I had envisioned building. Now, that's tricky, because it doesn't mean that Henry Ford couldn't have, when he got that response that I want a faster horse, the follow-up, and this is the key, sort of what you're really looking for are the strong unmet needs. He should have asked in response, why? Why do you want a faster horse? and what is it about a faster horse that would actually, would it give you the chance to stop along the way and sort of go get lunch? So the key point is, you're not trying to get the customer to tell you what to build. You're trying to understand what's wrong with existing solutions and what needs aren't being met. And then it's your job as the entrepreneur to have the vision for how to create something that will fill those unsatisfied needs.
Okay. Let's take some questions from the audience. There's one that just came up from Jan Peter Kiley. So he's asking, what kind of founders tend to be more successful? People who are best product owners with razor sharp insights versus people who stumble onto business models. And then he talks about your founders of Airbnb versus other founders. So what trends have you seen? What are sort of maybe shared characteristics or backgrounds of founders who tend to be more successful?
Yeah, we I think all desperately want there to be an entrepreneur type. it just rings true with every fiber of our being that entrepreneurs are special creatures. They have a tolerance for ambiguity, a propensity to take risks, a streak of independence. They'll break from the herd, break from the crowd. And I'm sorry to tell everybody, but there's a mountain of academic research that says if you try to find the background attributes and psychological attributes of successful entrepreneurs, it's nothing jumps out, nothing you'd expect. I mean, for a long time, there are some things that are true about entrepreneurs. Whether they're true about successful entrepreneurs is another question. Entrepreneurs are indeed more confident than the general public. There are some statistical associations. If you're the child of an entrepreneur, you're more likely to be an entrepreneur. Whether any of these things point to success, it's in the survey I mentioned of 470 early stage founders, successful and less successful. There were a few attributes that separated success and struggle, basically younger founders were less likely to be successful, that's tricky, right? Because does young mean less experienced, and so you have to run multivariate analysis because things get correlated with each other, right? Age is correlated with experience. Founders who had more experience in an industry are more likely to be successful. Having a degree from an elite school had nothing to do with success. Having an MBA, unfortunately, in my research, had nothing to do with success. So the answer is it's a big tent, and a lot of successful entrepreneurs live under that tent, and they come in all sizes and shapes and colors and ages and personality types. I asked these 470 founders to self-assess their personality type. Would people describe you as passionate, as visionary, as persistent? And again, there was actually, of the 15 attributes I looked at, the only one that separated was methodical. It turned out that founders who described themselves as methodical were more successful. Now you got to be careful when you ask statistically about 20 things and your standard for significance is 95% confidence. Some things just at random are going to pop through and tell you that you found the truth when you really haven't.
What about age? So we have a question on age. Have you found the correlation between age and success?
In my work, it was a moderate correlation. Older, better. And there's other work out there that, my sample is okay for this kind of work. There are other people that what you really want to do is have thousands and thousands of data points, and people who've had bigger samples and done more rigorous statistical work do find that successful entrepreneurs tend to be older.
Older as in like specific range? 30s. I've seen like 35 40s. To 40 is sort of the mid.
Yeah, exactly.
The median.
Yeah, and you can see why. It's tricky. It cuts both ways. You have a store of experience. You have a professional network, people you can draw on for help or to join your team. The other thing that's true, obviously, for somebody who's 40 years old, they probably have a lot of life commitments. They may be building a family. They may have a mortgage on a house, and so what might be true in that situation is if you face those commitments, you better be pretty sure about the quality of your idea before you take the plunge, quit your salary job, and become an entrepreneur. And so I would say one of the reasons older might be more successful is these are people with good ideas who are self-selecting into entrepreneurship.
Let's jump to failure and then come back to success again. So we had a question on failure, and I know this is something that you've studied a lot. So the question goes, what do founders do post failure? So you built a company, it hasn't worked out. Now you're like, okay, I gotta go get a job, or I have to look at other options. And often what you do post realization of failure and how quickly you realize you're not going to succeed really determines or impacts your chances of success at a later stage. So what can you share with founders who've failed at maybe their first or second startup?
Yeah, I know our audience is all over the world, so I have to qualify what I'm about to say, but by saying that this relates to failed founders in the United States, failed founders who raised at least $500,000. So again, not every entrepreneur takes that much outside money, and it's important to qualify it by saying it's outside the United States because the stigma of failure really is very culturally specific. It really it's very different in different parts of the world. Being an entrepreneurial failure in Brazil or France or Japan is quite different than in the UK or the US. So that's important. But in the US, as I've looked at failed founders, half of them go back and do it again. Which to me was really interesting. What it says is entrepreneurship is a career calling. It's people have a passion. So folks who've looked at this again with a sample of venture capital backed startups. I've got colleagues who've looked at serial entrepreneurs, so people who do it multiple times, and they've looked at success patterns for serial entrepreneurs. So it turns out that serial entrepreneurs who were successful the first time, 30% of them were successful the second time. An entrepreneur who failed the first time was 22% likely to, or excuse me, 21% likely to succeed on the next attempt. And a first-time founder was 20% likely to succeed. So what that suggests is there's not a big penalty for failing. If you try again, you've learned something. On the other hand, success tends to breed success. And then we can speculate what's going on there. Are these entrepreneurs just somehow better? Are they more skillful? Are they smarter? We can speculate that maybe they get access to resources the second time that helps their success because they were successful the first time, right? That they have contacts. Yeah. We can maybe speculate that they came from a socioeconomic background that favored them all the way through, right? Some people just find it harder to access the resources that entrepreneurs need. There's gender bias, there's racial bias, all the way through. So
there isn't a huge correlation between failure and success post failure.
Yeah, exactly. Exactly. We've looked at some. This is actually a fairly gendered pattern. As we've looked at bigger samples, female founder CEOs are no more likely to succeed or fail in the first attempt. But it turns out they're less likely to try again. And with colleagues at Harvard Business School, we're puzzling over what's going on there. So
we have another related question, and we move on. I know we have loads of others on founders. So again, I think Jan Peter is asking, sometimes he's spoken with employees that said the removal of the founder made it possible for more insight-driven decision-making. Are there any factoids or stats, or insights that you can share with regards to non-founder-run businesses compared to founder-run businesses when it comes to success? Earlier, you said on average, after I think it was about 4 or 5 years, you said only about 40% of venture-backed startups are still founder-run. Do chances of success increase at that point?
Yeah, it's a wonderful question. It's incredibly difficult to answer that reliably and rigorously. The problem being, of course, if you've replaced the founder CEO with an outside CEO, there was a reason for that replacement. So probably the company was in trouble. So if companies with outside CEOs have a higher failure rate, were they headed in that direction? And is it actually true if we'd kept the original founder CEO in place, the total failure rate would actually have been even higher? You can't observe the counterfactual here, which is if you kept the founder CEO in place, what would have happened? So yes, if you bring in an outsider, you were probably in trouble, and these firms fail more often. But I don't think we can conclude it's because of
Okay.
addition of the outsider.
So there's a
Very tricky
correlation, but not
statistical.
necessarily a causality.
Yeah, exactly.
So we have from Shandan Chaudhary in India. So this is a typical question. You know, I see this sort of question a lot from, you know, markets like India or other markets. So, you know, in America, a startup can raise $500,000 or $1 million relatively easily. But, you know, in my market, that's very difficult to do. So, you know, what are startups meant to do, you know, when they're not able to raise that sort of funding? And is there a clear correlation between startups who raise larger amounts and startups who succeed? Obviously, relatively speaking, right? We're not talking about becoming a unicorn, but going back to our earlier definition, is it, you know, plausible to say, you know, there are lots of startups out there that can succeed with much smaller amounts of funding, but still go on to become multi-million-dollar businesses as opposed to multi-hundred-million-dollar businesses?
Yeah, no. I think it's just the opposite of where we're headed here. I'm sure that the less money you raise, the more successful you're likely to be. In terms, if the measure of success is, have you built a business that survives? And that's for many entrepreneurs, building it and earning a living from it, and maybe employing some other people who earn a living from it. That's a fantastic standard, and businesses like that, they raise money if they need money from the founder's personal savings, from the founder's friends and families. You know, you may be in a village where there's a money lender who knows the family and has a relationship with the family and sort of knows enough about the entrepreneurial opportunity to take that risk. But when you raise money that way, you tend to be more careful, and you're not going to. Many of the traps in the book, the failure patterns in the book, come from growing too fast. It's absolutely the case that venture capital-backed startups, which raise a lot of money, are much more prone to failure. And it goes right to the core of the venture capital business model. Venture capital, everyone should understand, they make money, all of their money, on just a handful, a small fraction, 5 or 10% of their investments. A venture capital firm might have 60 companies in the portfolio, and 2 of them will yield a 50 times return on the investment, or a 20 times return, or a 10 times return. You know, we put in $1 million and we got $10 million back. And another 20, another 20 or 30% will sort of go sideways, give the money back, and 50 or 60% will lose everything. And
I just want to take a pause here, because this is a super important point. Sorry, not to interrupt you. I mean, for everyone on the call today, I know there's a shortage of venture capital or venture funding, you know, in many countries around the world. So what you're saying is actually there's an inverse correlation. You know, startups who raise venture capital are less likely to succeed, whereas startups who raise money from maybe friends and family tend to maybe treat that money differently and actually are more prone to succeed.
Yeah, precisely. And it's because of the venture capital business model. They need a handful of big winners, and they're going to push everything they invest in has to have the potential to be a 10 times return. And
therefore the risk is much higher as well.
Yeah, and they're going to push the founders to do all the things you need to do to go 10 times. But it's hard, right? To have an amazing idea, to just be able to handle the growth, to grow an organization that fast. And most businesses can't do it. I mean, the good news is I think most entrepreneurs who sign up for that plan know what they're getting into, but some don't. And in retrospect, many who did would say, the next time I do it, I'm not taking venture capital, because, it's fine if they've got 60 opportunities. For me, it's one. It's my one thing.
I mean, that's a super important point. And, as a founder myself, I've gone through this, multiple times. And again, to recap with everyone on the call. So, the growth point is super important, because you all of a sudden have funding. Therefore, that funding now, it sort of imposes this expectation of, say, 2 or 3 or 4x annual growth, which in itself can cause a company to break. The product might be great, the service might be great, the customers might be super happy, but growing at 4x takes a toll on founders or a team. Whereas when you don't have that external funding, you could be growing at 20, 30% a year and you're very happy, and therefore avoid the challenges that come with that sort of blitzscaling.
Exactly. And there's a big world in between the sort of friends and family and village money lender and venture capital. And that's the world which many entrepreneurs live in, which is a bank loan, right? You get the thing started and you get enough success, you have collateral that a bank can lend against. And by the way, the bank doesn't want to push you for hypergrowth because they want the loan to be paid back. So those companies are also more cautious and therefore have higher survival rates.
Yeah, great. We have a question from Catherine. So Catherine is asking, how many years down the line of beginning a startup should management decide when to shelf the startup? So say you built a company, you pivoted, you tried one way, you tried the other way. Have you seen any numbers of statistical significance in terms of years or months when it's time to call it quits and your startup just isn't working?
Yeah, so most will, I think if you look at the hazard of, basically when does the failure occur, it's going to be spread out very widely. And there's the question of when do people shut down, and the question of if you come back to them after the shutdown and say, was the timing right? Do you wish you had done it earlier? A large fraction of the entrepreneurs I talk to, failed founders, will say, I wish I had shut it down sooner. And it's a very hard choice for the entrepreneur. Shutting it down sooner has a lot of advantages, right? Everybody can move on to the next project. Maybe the investors aren't going to get their money back, but they'd rather have 20 cents on the original dollar than nothing at all. And so it's important to understand all of the pressures on the entrepreneur to keep going. And there are a lot of them. Basically, there are a lot of things you can try to do when your company is struggling. You can try a pivot, sort of new business model, and it takes time to figure out whether those pivots are working or not. And they consume resources in the meantime. So it may actually accelerate the demise. You can try to sell the company, and that takes time. And it gives you initially often a very positive signal, because what competitor wouldn't want to take a look at what's going on inside your company? So a lot of people will talk to you, and then they'll string you along, because the longer you take to make up the longer they take to make up their mind, the more you're running out of cash and you're getting desperate, and you may sell for a bargain price. So there are a lot of things you need to try to raise more money. The identity of an entrepreneur is somebody who's persistent. So if I throw in the towel, if I say it's time to shut down, quit, am I a great entrepreneur? Have I failed as an entrepreneur? People are counting on you, right? You've got employees, their livelihood, their salary, maybe their medical benefits come from the company. So there's many, many pressures to keep going, and most entrepreneurs probably go longer than they should. It is one of the reasons the book is divided into sections: early stage failure, late stage failure. So it's still the case that if your standard is will investors make money, that startups that are 5-10 years old still fail by that standard at very high rates. Like 1 out of 3 will fail to make money for the investors. Wow. And you'd think that these companies had sorted through so many problems, but the problems just keep coming and they evolve, right? A 5-year-old company is very different than a 5-month-old company, and faces a whole set of new challenges.
The problems will persist. It's just the nature of the problems will differ. Yeah. And so earlier we said, there aren't common traits across entrepreneurs. I just want to, caption or sort of caution that I think there is, like, grit and perseverance is probably, it's highly unlikely that you're going to build a business and a successful business without having these two. Would you agree with that?
I agree. The question is whether everybody who tries it is gritty and persistent, and overconfidence is absolutely a trait of all entrepreneurs. And we need it. Society needs it. We need, like, if you actually think about the failure odds, no one would do it. So every entrepreneur will think that she's the exception to the rule, and some will be, and many will not be. So I agree with you. There are people who are temperamentally not suited for the job because the job is so demanding.
Yeah. Jumping on to a question from Abbas. So Abbas is asking, did you find correlation between founder equity and failure or success? Is the business more likely to succeed when founder equity is more heavily invested?
Didn't look at it again, because the set of firms I looked at tended to raise outside investment, either from angel investors or from venture capital firms. And in those firms, basically the founders at the start own 100% of the equity right before they raise the money. And then a very typical pattern is you raise enough money. The outside investors usually want to take about 20 or 30% of the equity when they make the investment. And sort of magically, the share price tends to get negotiated in ways that that's the outcome. So there wasn't, and then from that point on, if the company, and so now the founders collectively own 70% and the outside investors own 30%. If you need to raise a lot more money over time, just because of the nature of the business you're building and how fast you're growing and the investments you need to make, then obviously the founder's share will shrink as you bring in more equity from the outside. But no correlation between where founders end up and the success or failure. Okay. Frankly, a lot of firms fail early when the founders still own a really big chunk of the equity.
Yeah, we have a question from an anonymous attendee saying, I know there's a lot about this on the book, so in the interest of time, if you could give us like 1 or 2 examples, what are early signs of failing startup? What should we do once we notice it, throw in the towel, make up for it? That's sort of multiple questions, but maybe give us, what are sort of 2 glaring signs a startup is on track for failure?
The product isn't working. And by working, I mean, either people are not buying it, or if they do buy it and you want them to buy it again, renew a subscription or repurchase again, they're not doing it. That's a huge problem. And then the question is, do the founders see it, and are they willing to see it? I mean, they may have blinders on. We all want to see what we all see what we want to see. So are the founders recognizing the problem, and do they have a plan for doing something about it? That's the biggest cause, 100%. Second big cause would be co-founder conflict. It is often the case, particularly when the problems start to manifest themselves, that the co-founders will disagree in very fundamental ways about the way forward. And a startup can get paralyzed if the founders just can't make decisions. This happened at Quincy Apparel. They each thought they were the boss, and that they had to agree on everything. And of course, the time it took to reach agreement meant. Okay. So those are the two signals I'd look for.
Great. We have another question from RY. So RY is asking, what is an ideal growth rate for a startup that could be considered as a success? Is it linear versus sort of exponential growth? Forget maybe ideal. Let's say if I would rephrase that from what you've seen, is there a correlation between a particular growth rate and success? We touched a little bit about that earlier, and we said actually slower growth rate tends to increase chances of success.
Yeah, no doubt about it. One of the late stage failure patterns is, I call it a speed trap. Depending on where you live in the world, the police may use radar to catch a driver that's driving too fast. In the US, that's called a speed trap. And it's absolutely the case that many startups scale prematurely. The early stage startups may try to grow too fast, and they just can't handle it. And it's also the case that some late stage startups grow too fast, and all sorts of things, bad things happen. The next wave of customers, to sustain the growth, they are not as interested in the product. You have to spend a lot on marketing to acquire them. You have to discount the price to acquire them. They don't repurchase as often. So no correlation between growth rates and success. And in fact, growing too fast or growing prematurely is often the path to failure.
Okay. We have a question from Amit Gore from India. So he's asking an interesting question about common objective among the most successful entrepreneurs. Is it valuation? I want to build a business that's worth so much money, or solving a problem, or fame, or recognition. Did you see a pattern?
Yeah, my 470 survey founders, I asked about their motivations. I asked them about building personal wealth. That was low. Only less than half of them said that was important. Independence is and then, by the way, the same motivations are true for the struggling founders and the successful founders. It's just in each case, the motivation was stronger for the successful founders, not a big statistical difference. But independence is very important, and that's like 80% of the founders said that's what I want to be my own boss. I want to have autonomy. I don't want to be a cog in a wheel of a big corporation. And then the second big one, almost as big as independence, was impact. I want to put something out that's going to change the world and make the world a better place, create jobs for people. So I think those are common motivators for all entrepreneurs.
So we spoke a little bit earlier, or actually there were a bunch of questions earlier regarding skills, and you said there's no correlation between those who have an MBA or those who've gone to schools like Ivy Leagues and those who succeed in startup world. I would again I would underscore that with maybe not necessarily a correlation with MBA, because less than probably 3-4% of the world has an MBA. But what would you say to founders going in to build the business with no business skills? So we have many questions today saying, I have no business skills, I have no business background, but I really want to build a business. Can I do that?
Yeah, no, that's a big problem. There are a lot of people who sort of wonder about trying to learn entrepreneurship in school. Isn't it impossible to teach an entrepreneur? And the answer to that is no. There are things you need to know about running a business if you're going to be a successful entrepreneur. You need to know something about accounting. You need to know something about marketing. You need to know something about production. And the list goes on. And this stuff can be learned in lots of different ways. It can be learned at school. It can be learned by reading books if you have the discipline to do that. It can be learned from mentors and coaches. But you have to learn these skills. And the best way, of course, to acquire these skills is to learn them in a structured way and then apply them. So learning by doing is powerful. I would say the correlation, lack of a correlation to success to the elite schools. It's often I talked about younger founders having. So I think what I'm seeing in that data is a lot of the folks at elite schools come from a privileged background, and they can get the attention of investors. They may not have much business skill. They may not have much experience, but they can get access to the machine that will invest in startups. And they may not have as good an idea as an entrepreneur who comes from a different background, but who has trouble getting the attention of investors.
You're right, and there's sort of a link there, right? So you say, you have the access to the network, and therefore you're able to secure the funding, and then there's perceived success there, but in reality, that doesn't end up often being actual success. I found that there's also a correlation between what I call, hunger or desire to succeed and need to succeed and actual success. If you come from a more privileged background where ultimately failure doesn't have the same sort of repercussions as it might have on others, which also comes with age, and might be one of the reasons why, when you find that chances of success is higher at 35 plus. When you're 22-year-old, you're having fun, you're going to move on.
My academics who study the propensity, so who is likely to become an entrepreneur, sort into two categories. There's the privilege. I can afford to fail because my family has money. I made money somewhere along the way. And then the entrepreneurship of necessity. I lost my job. I'm in a community where it's hard to get another job. I've got to do this. I have this idea, and this is the best path for me out of my circumstances. And there are many entrepreneurs of both types.
Are you okay to take a few more questions?
Yes, I'm fine. I'm good.
I know we're running over time. So Sachin Goel is asking a good question. If a person has multiple ideas, what is the best way to assess and validate those ideas and finally arrive at one? So again, from your research, have you found there to be a particular correlation between success and how people have come up with that idea, or how they've chosen the one idea?
Yeah, I love the discipline of design. Design, and by design I don't mean just visual design, sort of how the thing looks. I mean truly understanding the customer, the potential customer, what they need, and translating that into a solution. And so what designers would say is you generate early in the process as many ideas as you can. So that's a good discipline for founders. Many entrepreneurs will will zero in too quickly on a single opportunity, a single problem solution pair, and will ignore the range of problems they might be solving and the range of different solutions. So absolutely, you want to live with lots of ideas for a long time, but you need a process for designers talk about divergent thinking, a process where you expand the problem space, and convergent thinking, where you have a rigorous process for throwing out ideas, converging toward a single idea. And that's what you should be doing. And I'd encourage everybody listening, it's not hard to find on the internet, the basics of design thinking. And that's a powerful toolkit for an entrepreneur. I think every successful entrepreneur in the beginning should have the mindset of a designer.
Definitely. We have another one from Parvesh, who is asking, is an idea worth working on? So, you have lots of entrepreneurs out there who have an idea that is a problem, but the addressable market size, whether regardless of how you look at it, is just very small. Have you seen, again, a correlation between maybe, failure and market size?
Yeah, too small is definitely a problem. The issue, of course, is whether you can start small and expand into adjacent segments. Focus can be a real advantage to an entrepreneur, sort of zeroing in on a very specific customer segment, maybe a small segment. And what you'd love to have is a 70% share of a small market, and then expand from there, rather than having 0.7% of a big market. When other companies out there have better resources and more insight than you do. So yeah, if there's no path to bigger, then you do have a huge problem.
Okay. It's COVID time, so I got to ask something, COVID related.
Yeah.
And is there, what can you share rather in terms of companies or ideas that started during times of, I don't want to say pandemics because there haven't been that many, but maybe crises. We have lots of questions about your ideas that are COVID related.
Yeah, this is important, I think, for everybody on the call to understand. So I'm going to localize to my experience at Harvard Business School. So we watched our graduates from the classes of 2009, 2010, and 2011. These are the classes that suffered through the Great Recession of 2009. Mm-hmm. There weren't as many jobs out there. And again, the entrepreneurship of necessity, right? You couldn't go work for McKinsey or Goldman Sachs. Now you were going to work on your startup idea. So they did. They worked longer on those ideas. Venture capital firms, as is often the case during and right after the crisis, weren't funding as many things. So the things that got funding were, by their nature, better ideas, right? The VCs will pick the good ideas. And when they started, they faced less competition. The big companies in the world, they had their head in the sand. They were just trying to survive, so they weren't focused on entrepreneurial space. And there were fewer startups. So we've seen from Harvard Business School some of our greatest success stories that come out of soon after crisis for all of these reasons. And I think the same thing is going to happen post-COVID. And I actually think it'll be amplified. I mean, the Great Recession of 2009 didn't change the way we work and live in fundamental ways. It was essentially a banking crisis, a financial crisis. Yeah. This one has made fundamental changes in how we work. Who's going to go into an office? How comfortable we all now are with this technology we're using at this moment. And collaborating, so entrepreneurial teams, it'll affect both demand and supply. From the demand sense, there's going to be new opportunities, and the way we're entertaining, streaming media all over the world, a big new thing, collaborative work. So the demand will change, and change creates opportunity for entrepreneurs, but also the supply. So there's so many parts of the world that are startup hubs because entrepreneurs and the folks who invest in them will collect together. But now the teams can be anywhere in the world, right? We've gotten very comfortable with working together online with Zoom and so forth. And I think that's going to open up opportunity for entrepreneurs any place. And teams will be dispersed, and that's going to be truly good, I think, for society.
Fantastic. Maybe we take a final 2 questions or so. We have a very sort of personal question from an anonymous attendee saying, I started a startup based on hyper-local delivery. It started well. 3 months down the line, sales started dropping. Morale started dropping, and then this person's parents, started pressuring him, presumably, or her as the founder, to probably shut down the business. And a lot of people face similar conditions. So this may be a bit more of a sort of advice, based on what you've seen, going back to the point of persistence or grit. How does one deal with that situation? And is it uncommon for a founder to be told by their closest family members or friends, hey, you should be shutting down your business, it's not working, stop doing this, go get a real job? That sort of dialogue. How should people deal with that?
That can be a blessing, a huge favor to an entrepreneur, right? And too often, the entrepreneurs working so hard, they actually alienate their closest relationships. If they have a significant other, the significant other is losing patience. The family, you've lost touch with your friends because you're working so hard, and you don't have anybody close enough to you to say, stop. Think about what you're doing. The real question here for this entrepreneur ought to be, are they excited about what they're doing? Do they wake up in the morning excited about going in and solving all the problems that have accumulated since they went to sleep? And are they proud of what they're building? Are they solving the problem they set out to solve at the beginning? Are their employees excited? And if the answer to those questions sort of, you as an entrepreneur always have to ask why. Why are you doing this? It is so hard, so many sacrifices, such hard work, a substantial risk of failure. If you don't have a clear answer to why, then you should stop. And a family member that can force you to confront whether what moved you in the first place is still moving you is doing you a favor.
Swapnil asks, what phase do you think most startups fail? So again, your book goes through early stage and then growth stage. What is the sort of the spiral of death stage, or the phase where the largest percentage of startups tend to fail?
If it depends how we define a startup. So I tend to define a startup as when somebody quits their day, a salary job.
Okay.
Many people will work on ideas nights and weekends, but as long as you have the safety net of a salary under you, I don't think you can call yourself a startup founder. You're doing something entrepreneurial. An entrepreneur pursues opportunity without resources, but a true startup is an organization that's searching for an opportunity, and it needs the full-time commitment, in my view, of the founder. So if that's the standard, I would say the failure curve starts very high, like it's going to start in 1 month in and be very high, and it's just going to continue to be high all the way through. It's going to be reduced over time, but even out at the 5-year point, there's still going to be like a 1 in 3 chance that the thing you're building. So earlier, higher mortality rates, just because it's easier to generate ideas and easier to kill ideas in the beginning because you don't have a whole bunch of commitments. If you've generated, if you've launched a product, if you've recruited a team, if you've attracted some money, whether from friends and family or a bank or outside equity investors, then you've probably made enough progress that you've at least proved there's something good about your idea. So the risk of failure is going to decline, but it remains all the way through.
All right, fantastic. Well, thank you so much for joining us today, for sharing your insights, and it's quite fascinating. I'm sure we could have multiple follow-up sessions. We have, unfortunately, 130 remaining unopened questions or unanswered questions. Thank you, everyone, for joining us from all across the world. We will be sending you all a follow-up email after this webinar, which I believe includes about 3 chapters of Dr. Tom's book, which you can download for free. And then obviously we'll send you the link of the book depending on where you are across the world as well. Any closing remarks from your side?
No, only this is a lot of fun and fantastic questions. So I want to thank everyone for listening, for the questions, and Fadl, thanks to you and Nexford for this opportunity.
Thank you. All right. Bye, everyone.
Bye-bye, everyone.